you are a trader who trades on the market using strategies such as moving averages, Fibonacci, Elliott waves, Ichimoku, traditional price action, or other supple tools, you will either constantly lose your money or lose it in the near future. Or maybe you are constantly looking for a new way to make money, and after some time it turns out that it also doesn't work. As a trader, I will tell you that there is nothing wrong with using indicators, even the most complicated ones, but without basic knowledge about the market, none of them will help you in trading. On the contrary, you will constantly lose your capital. Why? There are several reasons. First, you need to know how institutional players work on the chart. This is because all markets are subject to manipulation by large financial institutions. For example, 80% of shares are held by corporate players who can manipulate prices in any way they want. This is why retail players are always on the losing side of the market. They are just capital providers. How many times have you taken a good position in the market, and when economic data was released, your stop loss was activated and the market later went according to your earlier prediction? How often has the market make a breakout to upside or downside, and suddenly after breaking out, the market changes and trade in the opposite direction? How many times have indicators shown you a signal to take a position and the market suddenly changed direction again? You need to know a few things. First, institutional players know how the retail traders think and how to manipulate them to deceive the majority. Second, markets are manipulated by large market participants who have enough financial resources to change the trend in the market for their own benefit at given time. Third, to read the intention of the big players and follow them, you must learn the basic of market mechanics, such as how big players buy and sell assets. Fourth, all indicators that you use have a delay, thus generate a lot of delay signals. If the indicators mentioned earlier work on the market, everyone could easily make huge profit every day, but they don't. Although most indicators are available for free as the knowledge of how to use them, the majority of people still lose money. A coincidence? I don't think so. To track big players, you must analyze volume, because volume is a money. And money is a fuel for markets. By observing volume, you will be able to effectively follow big players in the right direction and make money. If you think that traditional chart and few moving averages works, then you better give up trading now. Large players control asset prices regardless of whether it is a forex market, stock market, future, or crypto. Those players showed their intention through generating high volumes on chart, which means they either inject large amount of money into the market or withdraw it. You can observe their activity by analyzing the volume. If you don't believe it, listen James Cramer, a former hedge fund manager, in an interview with The Street, where he admits manipulating markets.
I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. It's going to create a negative view.
Similarly, Tom Williams, the creator of volume spread analysis and manager of large US financial syndicate, acknowledged that he never heard the truth about market in the media. Why?
I've never heard the truth in the stock market, ever. Because if you're a professional trader, you're not going to tell everybody what's going on. Because the market has to have losers.
Therefore, traditional methods available in the markets are good toys for amateurs who believe they can beat professionals in the market. The brutal truth about the trading is that it's not as easy to make money as a fake educators claim. It is a profession like any other, and to succeed, you must dedicate yourself to it, and your work will pay off. You need to effectively analyze the market regarding price behavior and the activity of large players. Volume is the only method for effectively making money in the market. Making money money in the market becomes easy if you understand how large players operate in the market, so you can follow them. The rest of the market participants are capital donors, and most of the indicators are worthless and used by the brokers to make you think that trading in the forex market, for example, is super easy and you can generate thousands or hundreds of thousands of dollars every day. Most people start with the difficult forex market, learning a technique briefly from YouTube or free PDF, and quickly lose money in trading. Then those same people look for another golden method and repeat the cycle until they lose all their capital again. The truth about the market is that there is no holy grail, and the profitable traders is one who studies chart and understands the law of accumulation and distribution carried out by the large players. And remember, the analyzing the market is studying price action and volume. If you learn this and have the tools to effectively read the volume, you have a good chance to become professional investor or speculator in the market. If you are still here, it means you are interested in the topic, and I think I can help you transition to the profitable side of the market. Let me introduce you the pioneer of Wall Street, the father of technical analysis. Richard Wyckoff worked with many well-known individuals on Wall Street during his time, including Joseph Livermore and William O'Neill. Through running his own brokerage firm, Wyckoff had the opportunity to observe large players and how they placed orders and manipulated stock or future contract prices. He therefore noticed patterns that accompanied the accumulation of large capital. This is the accumulation process, and withdrawal a large capital. This is a distribution process. Those patterns operate in all markets in any time frame from 1 minute to 1 hour, 4 hour, daily, and even weekly chart. Those rules don't change because in the market, the only law that works is the law of supply and demand. There is no other. Now pay attention. On March 20, 2014, the Financial Post published an article, The Secret Trading Strategies from the 1930s that hedge fund founders don't want you to know about. In this article, you will learn that despite the passage of time, Wyckoff's method is still alive, and hedge fund managers really don't want you to know about it because his knowledge shows how big players manipulate markets. From the article, you will learn that if you want to succeed, you have to learn to recognize the professionals and understand what they are doing. That's what those who follow Wyckoff do. They watch the large operators. So how do you recognize the professionals? Professionals can be noticed on the market thanks to their high activity. This is what volume monitoring is. Volume equal activity. Very high volume activity at the end of the declines and large candles spread usually mark the end of the move. This is sign of panic where corporate players take advantage of buying at the discounted price. The opposite is true as well. In euphoria, retail traders are buying while institutional traders are selling. Here are a few examples. Notice that on every chart, big movements start with the same pattern, which is the entry of big players into the market. British pound, big drop, big candle, which indicate panics, ultra high volume, and trend change. Retailers are selling, professionals are buying. Japanese yen. After big drops, we see ultra high volume and quick trend change. Retailers are selling, professionals are buying. Facebook stock. After bad news, the market opens with a big downward gap, after which big players take advantage of the promotion and we see their activity on the volume. In just 5 months, the stock rise by 100%. Coca-Cola stock. Increased volume and visible consolidation, after which price goes up. Then at the top, we see profit taking and distribution pattern. Stock fall and again form a sideways patterns, and the end of which we see ultra high volume, accumulation process, and stock rise again. Let's now look at the cryptocurrency market. Bitcoin. After big drops, we see a big spread and downward candle and ultra high volume, which means big capital. The entry of big players. Shortly after that, Bitcoin rises by almost 100% in 6 months. Ethereum, the same pattern. Big spread, big volume, followed by rises. Again, the situation. Big spread, big volume, and again rises. This pattern works on every market, on every time frame. They also work well in day trading. However, regular volume is not everything. Big players can also hide their buying or selling intention by trading in waves that we see on the chart. That's why Wyckoff, over 100 years ago, taught his student to think in terms of waves. He created the concept of cumulative volume or wave volume, which shows the sum of traded volume on waves. And thanks to that, we have a perfect picture of the market and we can see exactly whether big players are buying buying or selling an asset in opposite to the rest. Thanks to this, we can make perfect, almost perfect investment decision. Cumulative Volume was first encoded on TradeStation, platform by David Weiss, an outstanding volume reading specialist, my longtime mentor with who I was able to practice market analysis in volume behavior for many years since 2012. And David Weiss is right now considered one of the best contemporary specialists in Richard Wyckoff Method. So how does wave volume work on chart, and how do professional traders achieve huge success in the market thanks to volume shown on swings? You definitely won't see this on regular volume available on platform. So once again, what is cumulative volume and how does it work? It is the sum of shares or contracts exchanged, sold or bought in a given time during a given wave, upward or downward. The numbers are expressed in hundreds or thousands of exchange assets. This allows for a good recognition of when large players are buying or selling their position. In summary, Wyckoff wave volume and Wyckoff wave chart show turning points on each market. Supply and demand change the price of assets, and their imbalance on the market determines movement. This enables you to make accurate investment decisions and generate significant profit. Therefore, if you want to be on the right side of the market and see what others don't see and trade like a professional, I invite you to volumedaytrader.com, where you can immediately get professional indicators for MT4, MT5 platform, as well as TradingView, and analyze the forex market, stocks, futures, commodities, or all cryptocurrencies. The indicators are available in monthly and yearly subscription. Along with the indicators, you have access to cyclical analysis of the current market and training to continuously practice market analysis technique based on volume and price action, and have my support. If you want to become a professional trader generating steady profits, this knowledge is priceless. If you have been using various indicators that generate signals with significant delays when the market is usually already bought by large players or oversold, I guarantee that you will no longer need any other tools. Volume indicators don't predict anything. They give a current price, they give a current picture of the market and shows the involvement of large players. This is crucial in making the right decision. There is no holy grail in the market, and if you are looking for it, you are just wasting your time. You have to learn to think independently in the market and follow institutional players. Additionally, I have developed another indicators confirming accumulation or distribution. Wyckoff wave trend, which is based on volume and averages prices, effectively shows trend changes as complement of the entire volume analysis. It works great in day trading on 15 and 60-minute charts, and in swing trading on daily candles. Here is how it works on different markets. Bitcoin. Let's go back to the last bull run. When Bitcoin began to appreciate significantly at the end of April, the Wyckoff trend indicator changed color from red to green. It's a bullish pattern. A year later, Bitcoin changed color again to red, and we see a significant drop in price. A few months later, Bitcoin changed color to green again, and we see a clear increases in prices to a new high. At the end of the 2021, the Wyckoff trend indicator changed color to red, and we had a drop in prices to the last lows. At the beginning of 2023, the indicator gives a bullish signal again, and the market enters another bull run. The indicator was great in the forex market. Euro drops, increases, drops, increases, drops, and the last trend change position the euro in a bullish position. This indicators works on all market. In summary, if you want to start making money in the market, you need to act like professionals, not like a retail capital provider. You must have tools to see more than others. You must give up traditional indicators in favor of those that analyze volume, because, as I repeat, volume is money, and money is a driving force behind the market. Lastly, there is a link to volumedaytrader.com where you can accurate the mentioned indicators and access to market analysis and training. Ready? Check us out on volumedaytrader.com.